Yeah, but if I don't pass them, it's almost nice because then I get more points.
Hey, good morning, everyone. Nothing like coming back from spring break on snow, right? All right, welcome to Advanced International Taxation. You guys are the brave souls who are sticking it out. So the good thing is I think when we get through with this half semester, you're probably going to see all of the big picture of international taxation, especially from a U.S. perspective. From the outbound, remember that's U.S. out. Investing abroad, and then inbound from abroad into the United States. We'll hit all of the main topics. Those of you that were just coming out of international taxation, kind of one of the things I was feeling from the final exam, I'll just pass along, is this might be a little different than some of your other courses because we are hitting topics and regimes. It doesn't like really flow one from the other. Like if you contrast this with taxation of business entities, we kind of go through the entire lifeline, if you will, of taxation of a corporation. This is kind of like, feels like hit and miss. That's just the nature of the topic, is the government just hits certain areas, and what it does is it builds on corporate taxation in the corporate environment, but adds on different regimes for international activities of those corporations. So if you're feeling that way, don't feel bad about it. That's just the way it is. And so we're going to hit some more of those topics, a little bit more advanced topics in the course here. You guys know how to get a hold of me. Email is the best. I always monitor email. If you have any questions, want to meet outside of class or anything, just shoot me an email and we'll work out a time to do all of those things. That's the easiest way to get a hold of me. Besides walking up or raising it. Okay, so kind of the flow of the half semester. I am going to dig into Chapter 9. I apologize for doing that. This is your first class back, but we only have so many classes together in the half semester. So I do want to make some progress on Chapter 9. So Chapter 9 is going to be on inbound planning, so investment from abroad into the United States. If you remember, we ended last half semester with Chapter 10, which was when that foreign person is actually doing a business in the United States. At what threshold we become taxable in the United States, and then how do you pay tax in the United States? Basically on the same computation as a domestic corporation. Computation of gross income less expenses equals taxable income times 20%. So this is going to be a little bit different. This is going to be the more passive investment in the United States. So think of a foreign person who's an investor into the United States who is deriving passive income streams from the United States. As you know, the United States is extremely popular, if not the most popular investment destination in the world. We have the most liquid markets, largest companies in the world. So lots of non-U.S. Individuals and companies invest in the United States markets, either via stocks, via bonds, via lending, those types of things. So we're going to talk about that in Chapter 9. And then an element of this course, compared to the prior courses, we are going to add some planning elements into this. So we're going to be thinking about, in Chapter 11, the planning that a foreign person will look at in investing into the United States. Like, what are the things that are top of mind to try to minimize the global tax burden? So we're going to go through, there's several cases there. They're very straightforward. I would like you to sign up for them if you want to get your class participation points. And we'll go through those, but it'll kind of give you the round out all the topics we've been talking about from a planning perspective. We're going to jump into some specialized topics on the outbound perspective. So these are very niche areas for U.S. investment abroad. Foreign currency. Foreign currency I've always found to be one of the most challenging aspects of international taxation. We talk about doing transactions and investment abroad and investment from abroad in the United States, but there's different currencies involved. Not everything's U.S. dollars, right? As you know. But U.S. tax returns and U.S. tax computations are done in U.S. dollars. So to the extent you are doing transactions that are denominated in other than U.S. dollars, you have to get back to U.S. dollars. So there is a translation element that we have to go through, like different points in time that we measure the translation to get back to US dollar. And then there's an economic element. You can either gain or lose on, depending on what your currency is versus the denomination of the transaction that you're doing, right? I equate to taking a vacation, right? If the dollar's strong and you work in the United States and make US dollars, going to Europe is on sale, right? Because you're taking more valuable dollars and buying things in euros. You lose when the dollar is weak against the euro when you go to Europe. It costs you a lot more dollars. So it's the same thing. That economic element has a tax effect. The government will tax you on the economic benefit if you get a benefit from a foreign exchange transaction, and will also give you a loss if you have a economic loss to a currency transaction. The currency elements can get very, very, very complicated because, right, companies that are exposed on a currency issue will go out and try to hedge against that risk, right? So there's hedging transactions, there's derivative transactions, all kinds of very exotic financial transactions to deal with currency risk, and there's a tax effect to this. And this is an element, if you aspire to work at a Big Four accounting firm, all of them have national experts on currency matters, both from a financial accounting perspective and a tax perspective, because these are things you do not want to get wrong. You got to get the timing right, you got to get the numbers right. And in my experience, the numbers are never small. They're usually got a lot of zeros on them. And this isn't one of those areas that can kind of sneak up on people. And if you're not looking at it at the beginning of a transaction and it comes up later, with it being oftentimes a big number, it can get people kind of excited. So I'll pass along some tips as to how you can be a good advisor within a company and for a company on how to smoke these issues out ahead of time so that you're flagging them. And then as long as business knows about an issue and they can either accept the risk or try to deal with the risk from a hedging perspective, my experience has been you're in a good spot. Because if it's a known risk, people can try to deal with it and be ready for it instead of it coming up late. So we'll talk about all things foreign currency in Chapter 6. Chapter 7 is a separate topic, export benefits. So this is a regime that came in the Tax Cuts and Jobs Act of 2017, Trump 1.0. And think about the Trump administration, right? They've been pretty consistent in 1.0 and 2.0, invest in the United States, manufacturing jobs in the United States. We want to own things in the United States. And instead of a multinational company choosing to invest abroad, we want to incentivize you to invest here. The export benefits was a way to do that. We talked about last half semester, GILTI. Remember, GILTI was like global intangible low taxed income, right? Think of that as a stick. Like, we think you over time, you built these intangible assets offshore that drew a lot of income. We're going to tax those. This regime that we're going to talk about in Chapter 7 is trying to, on the front end, trying to stop that from happening. So people could equate this to GILTI being the stick, and these export benefits, I won't give you the title of the regime yet, but that regime being the carrot, like trying to attract the investment to the United States. How do we do that? We're going to tax it less heavily than 21%. Trying to dangle a carrot in front of the decision maker saying, hey, do that here, and I'll tax you less heavily. And this was also affected by the One Big Beautiful Bill Act of 2025 last summer. So we'll go through that in Chapter 7. And then we're going to do our planning from foreign operations perspective. So this is your U.S. investment abroad. What are the things that are top of mind in the planning perspective from U.S. outbounds? Then we're going to cover two topics that we've kind of touched upon, but I want to dive into them in more detail here. And these are common whether you're an inbound investor or an outbound investor or you're advising one of those companies. Transfer pricing, that element where transactions that are done with related parties, so multiple subsidiaries or a parent doing something with a subsidiary, sale of product, the provision of services, lending of money, management fees, any of those types of intercompany transactions have to be transfer priced to an arm's length amount. We'll walk through the different methodologies that people use for that. But there are tax professionals who just go into transfer pricing. Usually they have an economics background because it's very much economic centric. But we'll talk about transfer pricing, and this is not just a U.S. issue. This is a global issue. Every country has transfer pricing rules, and countries can differ as to what is the appropriate transfer price, whether they're the recipient jurisdiction or the expense jurisdiction on what side of the transaction they're on. The second common topic we're going to talk about is tax treaties. We've touched upon that a little bit, but we're going to go into what the model treaty says. The model treaty is the starting negotiation spot what the U.S. puts forth when they are opening up a treaty negotiation with a company, with a country. This is our model document. So let's start with that and talk about what things we want to change from that on our negotiations. But I'll give you some ways to think about a tax treaty, how to read it, what's the common articles, and what they're saying. So we'll dive into that in chapter 13. And then we're going to cover some of the more cutting edge things that are going on. These are global initiatives stemming from the Organization for Economic Cooperation and Development, the OECD that I mentioned in Paris. What that organization is representatives, tax professionals, tax representatives from the government, not private industry, from countries go to the OECD panel and discuss about rules and what they should do. Basically what it is trying to get some coordination globally around how do we tax these enormous multinational corporations. When I first started practicing, there was no coordination among countries. As you can imagine, there were lots of gaps between the laws of the countries then, which opened itself up for lots of tax planning that you could do. To the extent countries get more coordinated, they can shrink the gaps to which you can do tax planning because they can premise their results on what happens on the other side of the transaction. And so these global initiatives, they're pillars 2 and pillars 1. The reason I invert those is because pillar 2 is moving faster than pillar 1. So countries are already enacting pillar 2. So what happens is these representatives sit in these meetings and talk about these things, and, oh, that's a great idea. And then they all go back to their home country. What do? They report to the legislatures and the decision makers in their country, this is what we should do. And these things start gaining traction around the world, and these laws get enacted. Now, each country can do their law the way they see fit, but you can see some themes because the OECD will put out model rules, just like the U.S. does a model treaty. So you start from that. So you see some similarities between these things. And this is a big issue for U.S. multinationals because this is happening to them, even if the U.S. doesn't want to participate in these rules. Right? Our current administration is not a enthusiastic participant with global think tanks about what rules should be. The U.S. tends to think we can do what we want from a tax perspective and other perspectives. But this is an area where even if you're a U.S. multinational, the U.S. is not adopting these rules. If you're in 50 countries, 45 of those countries might be doing these rules. And if you're in their country, you have to be compliant with the laws in those countries. So it's like, even if your home country is not involved in these things, it's still impacting you because the rest of the world is changing. And if we do have some changes in subsequent elections, where we have new parties in control in the United States, we might become more involved in these initiatives. And if the U.S. is involved in these initiatives, things kind of move faster globally as well. Okay, so that's where we're headed. The structure of the course is very similar. You guys have all been in one of my courses. We're using the same textbook as we used last semester. The class format will be the same. We have examples, as I mentioned, for you guys. So if you guys come up and volunteer to present, you will get class participation points. The other way you can get class participation points is just be interactive, right? You guys can talk during class, ask questions, make observations, anything like that will help. So that class attendance is 15%, participation is 20%, and we have one pass for final exam, 65%, same as international taxation. The format of the test will be exactly the same, multiple choice, short answer, everything you guys are used to. Emergency response, I know you guys have heard me say this before, but we had a scare a few weeks ago. I wasn't on campus, I assume some of you were. I've read some of the accounts, it seems pretty pretty scary. As you probably either knew before or learned during that incident, the university has trained us for 3 different responses, and these are common for these types of situations. I've been to the active shooter training here at the university, and it's taught by city police and the Washu PD. And so it's run, hide, and fight. So run is if we get the alerts and we know where the issue is, right? We know we can go out that door and immediately get outside this building. And we can get off campus pretty quick with a few more steps. So if we know that there's a problem on the other side of campus, we can exit campus. Now, if you were here during that, you know the information flow is not clean, right? Everybody's panicking, phones are going crazy and everything. So the likelihood of us knowing exactly where the problem is, right, the issue would be you might be running directly in the wrong direction. Okay? So absent knowing where the threat is, the second option is to hide. The good thing here is there's not a lot of visibility into this room. So if we knew something was going on, we could get underneath the tables, and it looks like nothing's here. If somebody opens the door, if they think the room is empty, the guidance that we've been given is they likely go to somewhere else. So the people that you make them, and if there's nobody here, then they may be. The other one is fight. That's our last option. That's the extreme. But what I would ask you to do is think about all the things that we have with us. We all have laptops or iPads, we have water bottles, we have phones, we have anything. Somebody came through that door and we had no other option. If we started throwing things at them, perhaps we could stop them for a moment to where somebody could get to them or something of that nature. But that's the extreme. We have to do that. But just be mindful of the things that we do have. What we don't have, which I've questioned in these training sessions, is we can't lock the doors. The issue is there's fire regulations for locked doors, and so the doors will remain open, so we don't even have locks on them. So I hate to talk about these things, but they do happen. We see them on the news. We saw it personally a few weeks ago. So that would be our plan here. I would ask you for every room that you're in, think about where you would go. Where is the exit? How do I get out of this building the fastest way? Right? Because when something happens, that's not the time to start thinking about what you would do. And knowing that it would be panic at that point in time. So just give yourself, always be aware of your surroundings. You guys have heard that before. Okay. You guys have seen this in the past. I just wanted to reiterate this. This is my 3-3-3 paradigm. Okay? A general rule of thumb is that you should spend 2 hours for every hour you spend in class on your coursework. Okay? So in the middle, we got 3 hours per week. So all these numbers are per week. We got 3 hours together per week. During that time, I would ask you to think about your attention management. What are you doing right now? I see some of you looking at your screen. What are you doing? So I'm not here to babysit. I'm not here to go around looking at things. So you guys are adults. I'm going to treat you like adults. But you've worked really hard to get here. Families have worked really hard to get you here. Can you shut out the rest of the world for the hour and 20 minutes that we're together? Right? It's not that long for you to be focused. So attention management, avoid technology distraction. Look to participate. Right? Look for areas where you can make an observation. Or, hey, how's that different from what we talked about on that other regime? How does this work in this situation? Or make sure you understand something. That is, what I'm trying to do is get you to start evolving into your professional self. That's what you're going to be expected to do in a meeting. Is be present, be focused, and be a participant in those meetings. That's what your boss is going to expect. That's what your client's going to expect. Okay? Don't think you can multitask. Do not multitask. I've read multiple articles from professionals who say the human brain is incapable of multitasking. If you think you can, what you're doing is you're doing 2 things less than the best you could do them. Because your brain can't do that. And I think this is a good way. We're all bombarded with things, but can you do this for a limited period of time? This is great training. I know it's a lot of work. It's hard for me too. When I'm at home, Watching a movie, I'm picking up my phone. Sometimes I leave my phone in the other room so I can't pick it up, right? So just see if you could practice that here. Be present for those 3 hours a week. Your grade will reflect that and you'll learn more. So then if I get 2 hours for every 3 hours you spend with us, that means you owe me 6 more hours. Or you owe yourself and your family 6 more hours. So I'm just trying to break that up into how would you spend that? You could spend, this number could be 2, it could be 1.5, whatever you're willing to spend, 3 hours before class. Read the materials before class. Come in here with nothing I say is brand new to you. You've heard it. Are you guys all doing that? Are you doing it consistently? Okay? Think of that as when your professional life, you're preparing for the meeting with your boss, with your team, with your client, right? You're not going to walk in there cold. So you're practicing that here in a safe environment. So read material in advance. This last one, I think, is one that students don't do nearly enough of. And that's periodically looking backwards. I know you're always trying to catch up with the next week's assignment, but can you spend some time on a Friday, a Sunday, whatever day works for you after classes is over for a week, and look backwards at the material? Flip through the slide decks. If you're taking notes on slides, all your notes make sense. Rewrite them. I found that very helpful in my career. If I came out of a meeting, especially when I had a big talking part, I would make notes on a piece of paper. I'd jot this down when somebody said something, and I'd go back to it. And if I didn't go back to it for 3 weeks, I might look at it like, what? I don't even know what that means. First, I can't read my handwriting. 2, I don't even know what that was. But if I did it a day or 2 later, I'd be like, oh yeah, I know what that point was. That's something we got to follow up on. So review the material covered during the prior week. Think about cleaning up your notes. And if you still don't understand something, how are you going to knock that out? Spend extra time on it, go back to the textbook, use AI, talk to me, talk to a colleague. How are you going to deal with that? Because you want to fill in those gaps. Because many times things in your classes build upon each other, so you don't want a weak starting point. I think that's similar to a professional environment where you got to-dos from a meeting, right? When you're a professional, you never want that to be the last meeting you have. My last slide in every one of my slide decks to a client was next steps. We would talk about what are we going to do next. I wanted to have another meeting. I wanted to get paid to do more things or get the client to do more things so we could do more things, right? That's similar to this. You're just wrapping up a meeting and looking backwards periodically. Okay, so many of you have seen this before and heard me on my spiel on that. What I was thinking about over the break is, okay, that's 9 hours from my course per week. Am I asking too much? So I did this. I said, okay, if you take 5 classes a semester, that is 5 full-time course loads, so you got 3 hours per class. That's 9 hours. So you got 5 instances of these 3 3s, right? That's 45 hours per week dedicated to all your coursework. Everyone's heard about a 40-hour work week? Pretty close, 45 hours, right? Nobody here is probably going to work a 40-hour work week. Professionals tend to work a little bit more. So 45 hours a week. So then, is that realistic? Because I know that's not the only thing everyone has to do in their life. So I totaled the total hours in a week. 24 hours times 7 is 168 hours. We all got to sleep. I assume we sleep well. We sleep 8 hours. Take 56 hours out. That means we got 112 hours of waking time per week. If I take out the 45 hours that you're going to put forth to your schoolwork, you have 67 hours a week to do other things besides sleep and think about school. That is 9.6 hours per day that you can do whatever you want. Stream Netflix, eat, take a nap, go for a walk in the park. That's a lot of time. So I don't think that's unreasonable to think about. This 3 3 3. 15 hours sounds like a lot, but when you look at it in the total scheme of things, I think you have plenty of time to do that. And plus it fits in with this mindset of this is what your work life's going to be, right? And so if you want your grade to be higher in my courses or your other courses, think about doing something like this. And again, these are just representative. It could be 2 hours before, 1 hour after, whatever. But the general maximum is 2 hours after, 2 hours per 1 hour of instruction. And I think, again, I want you to focus on, I know your grades are very important. I hear from it, GPAs, you guys are all focused on that. But I am as focused on you guys learning the material. And I learned by spending time with material. Before, during, and after. If you do that, and if you're consistent in doing that, I promise you, you will become a trusted advisor and be very good in whatever field you go in. Okay? So take that for what it's worth, but that's just areas where I think we could all do a little bit better. Okay. Let's talk about Chapter 9. Any questions? Okay, withholding on U.S. Source income. So, remember, the U.S. tax is foreign persons investing in the United States, so that's from abroad into the United States. Inbound taxation is what it's called. 2 different ways we address that, depending on what U.S. activity they're doing. We did Chapter 10 at the end of last half semester A. That was inbound investment doing a business. So you are doing something in the United States to drive business income. You are selling, you are maybe doing services, something like that, but you are extending yourself into the United States in a business fashion. So we've covered that. We're going to talk about here in Chapter 9 the passive type of investment in the United States. So you're not doing full-born investment in the United States, but you are investing from a perspective of you want a regular, recurring, passive income stream coming from U.S. sources. If the U.S. person derives investment-type income, technically referred to as FDAP, another acronym, tax people love their acronyms, that stands for Fixed, Determinable, Annual, or Periodic Income. What that is just think about regular occurrences of investment-type income. That could be dividends, interest, rents, royalties, those types of regular payments that are coming out. That's what FDAP means, even though they use strange terminology to describe it in the tax code. And it has to be coming from U.S. sources. Okay, so remember all the sourcing stuff we did in Chapter 3? When we look at those rules, we hone in on 1, what is our income stream? 2, what is the rule for sourcing? If it says it's U.S. source, then you're in Chapter 9. If it is not U.S. source, we'll go through an example shortly, you're not in Chapter 9 because the U.S. doesn't tax foreign source income from this perspective, to a foreign person. We don't tax the foreign source income of a foreign person. Right? We tax the foreign source income of a U.S. person that's guilty, Part F, net CFC tested income, all the stuff we talked about in the anti-deferral regime. But when I have a foreign party, their foreign source income is somebody else's business. The U.S. has no taxing jurisdiction over that income stream. But if it has a U.S. source, then the U.S. says, I have a chance to tax that. Okay? And we tax that on a gross basis, meaning the full amount of the payment, not reduced by expenses. When we do the Chapter 10 material, taxation on business activities, we tax that on a net basis, right? You get to reduce expenses against the income. We tax net income. Withholding is always on the gross payment. We don't care if you have expenses related to generating that, that's not our problem. We just look at the gross payment coming from U.S. sources and we tax that. And we tax that at a general rate of 30%. Pretty high rate, 30%. It's not graduated, it doesn't matter if it's $10 or it's $1 billion payment, 10% if it's got a U.S. source. And the way that rate can come down is through a tax treaty. That's one of the things that the U.S. uses as a negotiation tool with a treaty negotiating partner. That country might say, hey, 30% is crazy, we got to get that number down. And the U.S. will lower the other countries' withholding tax coming to the United States on the payment the other way as a condition for lowering our 30%. Okay? But if we don't have a tax treaty in place, right? Because you need two countries negotiating a tax treaty. And if we don't have a tax treaty in place, it's 30%. Okay? So if the payment is $100 from a US source, no treaties in place, then we pay $70 to the foreign recipient, we withhold $30, and the US payor remits that to the US government. That's the withholding tax. Remember, to individual taxation, same thing happens on the salary side. So you get paid once a month or every 2 weeks. The employer is withholding out of your paycheck and pays you the net amount and remits the withheld amount to the US government. Same concept here. The US is just putting this on the payor. In the individual setting, they put the responsibility on the employer. That's the collection mechanism. Withholding is not a US only concept. Every country has withholding taxes. So if you have payments coming the other direction to a US party, you're going to have the same issue. What's the withholding tax rate? Do I have a treaty that can lower the withholding tax rate? Okay? So withholding tax is a global concept. Gross basis, and then see if you get the rate lower than 30%. Okay. There are two US withholding tax regimes with respect to US source investment type income. The first is called FATCA, Foreign Account Tax Compliance Act. FATCA for the acronym. The FATCA regime imposes a 30% US withholding tax when a foreign financial institution is the recipient of a US source payment, and that institution does not provide information to the US IRS regarding its underlying US-based investments. So think of if I didn't have this regime and I was a US investor and I was going to make a passive investment into the US stock market, and I was going to get dividends paid to me. We know dividends are ordinary income taxed at my marginal tax rate, right? What if instead of doing that directly, I did this indirectly by making the investment through a foreign financial institution? So I had a UK bank. I made an investment through the UK bank into the US stock market. The dividend then was paid from the US to the UK bank. And if the US Treasury, the IRS, did not know that there was a US beneficial owner of that interest, then I'm pretty sure the US to UK treaty withholding tax rate is 0 on interest. I've just avoided US tax. You guys probably all heard of Swiss bank accounts and how to avoid US tax and things like this. The US got fed up with this and said, put the onus on the foreign financial institution. You tell me the identity of your investors, or every outbound payment I make to that from the US is going to be subject to 30%, the highest there is. And so this is not a very popular regime, because you can that concept sounds simple, but understanding who the owner is of an account and where their tax resident is not easy. And the United States essentially outsourced this entire requirement to foreign financial institutions. And of course, what did they say? Oh my gosh, you just made us do all this, and we don't have the systems in place to do this. The US said, fine, 30% withholding. Okay? So, this regime we do not study in this course because it's not the most common withholding that you see. We're going to be talking more about US multinationals and how companies invest in that type of thing, where you see outbound payments that are much more discrete instead of an overall investment plan for an investing public. You would most likely see this if you worked for a foreign financial institution. They have to be compliant with this regime, and they don't want to get hit with the 30% withholding. So it's very much more of a niche profession, and if you're going to be working for a U.S.-based company, you're not going to see this nearly as much. But I wanted to make sure you were aware that there were two withholding tax regimes. FATCA is very heavily compliance-oriented, placed on foreign financial institutions, or they get hit with 30%. And then this FDAP regime that we're going to talk about during the course. So if you want to go to Switzerland and work for a big investment house that does a lot of investing in the United States, you will get to know the FATF regime in a big way. Okay. Okay. We're not going to cover this. We're going to deal with more of the FATF regime. So, pursuant to U.S. domestic law, the U.S. generally taxes foreign persons' U.S. source income at a flat rate of 30. Tax treaties can reduce that withholding tax rate on interest, dividends, and royalties to less than 30%, and in some cases down to 0. Okay? When we get into the tax treaty material, you'll see there's articles. So there'll be an article on interest, there'll be an article on royalties, an article on rents, and those are just paragraphs, or maybe multiple paragraphs, but those are sections of the tax treaty. And that's where it'll say what the withholding tax rate is from one country to the other. And they're usually symmetrical. So if the U.S. grants 0% on interest paid from U.S. to U.K., the U.K. will grant 0 from U.K. to the U.S. Okay? The investee U.S. corporation, so the company that has been invested into, that's usually a corporation or a financial institution, making the payment of U.S. source investment income, dividends, interest, and royalties abroad, collects the tax via the withholding and remits that to the U.S. government, as we talked about, on behalf of the foreign person, paying the foreign person the net amount. Okay? So the foreign person doesn't, they have a little bit of compliance here because they have to put forth information to the payor as to what country they're in and whether they think a treaty applies or not. But they don't do anything. They don't file a tax return. U.S. payor of the income stream is referred to as the withholding agent. Okay? They are the one, they're an agent for the U.S. government. They are the collection mechanism. So, if they don't withhold the right amount, then they are liable for any difference between what they withheld and what the right amount is. So they are incentivized to get this correct. And what you usually find is they are conservative in making the assessment of the withholding tax. They don't get the right information from the foreign person, either from what country you're in or what treaty rate you think applies and why you think that treaty applies. I'm going to withhold at 30%. I can't get in trouble as the U.S. payor if I withhold at 30. If I withhold at 0 and the U.S. government comes in and says you should have withheld at 30, the U.S. government does not have to go chase the foreign person. They can make the withholding agent. That's why the withholding tax agent is very adamant about their files and the documentation that they receive and being conservative in nature. I have typically found this consistent with the rest of the world. Really, you have to convince the payor that I am entitled to pay 10% withholding tax, not 30. So here's all my information. Are you in good shape? You're going to pay me 90% of what I'm due, not 70%. So you just got to really work with them to get them comfortable because, again, they are liable if they do something. Okay. Commonly encountered FATF is payment of dividends, interest, and royalties from the U.S. It has to be U.S. source. So we don't just say it's paid from a U.S. party. We go through what is the income stream that is paid at issue, and then what is that rule. Remember, we had specific rules by income stream as to what the sourcing is, so it has to be U.S. source. And it's the traditional U.S. withholding regime on U.S. source income paid to foreign persons with documentation lowering that 30%. All foreign persons, non-resident individuals, corporations, and partnerships receiving U.S. source FATF income are subject to U.S. withholding tax. Okay? So we're looking for an outbound payment. Doesn't matter who it goes to. Right? Is it a foreign institution? Is it a foreign individual? Is it a foreign corporation? A foreign partnership? All those, I capitalize foreign person. Right? So it's a non-U.S. institution, person, individual, doesn't matter. It's subject to withholding tax. And it is, withholding is required unless there's an exception. We're going to go through exceptions in a moment. Right? In tax rules, we always have a general rule, and then we start off with exceptions. So we have exceptions to U.S. withholding, and then we also have the reduction via the tax treaties. We can or the rate from the 30. Okay, it's on the gross amount of that income. U.S. payor is responsible for withholding and remitting the tax and liable if they fail to remit or withhold the right amount. The withholding mechanism, I always think about that is that's for the convenience of the government, right? It ensures the collection of tax from the foreign person over which the IRS, which has the enforcement responsibility within the U.S. Treasury Department of the executive branch for enforcing the tax laws, they would not have the power to collect that tax. Okay? So the U.S. does not want to be in the business of going and chasing all the foreign persons around the world, one, finding them, and then trying to force collection from someone who is not in the United States, right? That is a very cumbersome, time-consuming process if that was the regime you're going to adopt. So the U.S. says, well, I do have the opportunity before the money leaves the United States to put the burden on the payor. That's the withholding tax mechanism. It's not dissimilar from individual income tax, right? Instead of the U.S. trying to collect tax from all individuals, the easiest way for them to do that is put that burden on the employer to withhold and remit, because now I know I get it every 2 weeks or every month, whatever payroll is for your organization. And it's much easier for the government to force somebody to do that, and they have the power of the pen, so they can write the law to make that happen without having to go and chase millions of people around the world to try to collect the tax. To withhold the correct amount, the U.S. payor needs to be able to determine the applicable withholding tax rate. That requires two things. What country is the foreign recipient in? What country are they tax resident in? And does a tax treaty apply? Okay? Those are not the easiest questions. Okay? So, say you're paying to a partnership, foreign partnership. The parties that receive that income are the partners in the partnership. So you got to go get information from the foreign partnership about all their partners. That's not, again, it's easy to say, hard to do. So this documentation exercise is very time-consuming for the U.S. payor. So again, think of the withholding as the government has just outsourced this to the payor. You do this. And if you don't do this, I'm going to collect the tax from you. I don't make you do it. Right? So the documentation collection around withholding tax is very, very time-consuming. Once the proper tax has been withheld, the foreign person generally has no further U.S. tax obligation or filing requirement. The transaction's over. Remember, contrast that with withholding tax for U.S. individuals in the United States. That's just a prepayment. We still have to file tax returns. Many of you are doing VITA. They're filing tax returns right now. And so they've had withholding, but you still have a filing obligation, and you either paid the right amount, unlikely, a little bit less, or a little bit more, so you got a refund or a payment that you have to do when you file your tax return. That is different on the withholding on inbound investment. Once I withhold, the foreign party is done. They do not have to file a tax return in the United States. It's kind of the final settlement of the tax is the amount of withholding. No need to file a tax return. Okay, let's talk about exceptions to U.S. withholding tax on that income. We're going to go through 6. If connected with a U.S. business income, gain from the sale of U.S. personal property, what is called the portfolio interest exception, the U.S. bank deposit interest exception, tax treaty reductions we've talked about with withholding tax rate, and personal services income. I will tell you, some of this is you'll find in the various parts of the tax code you may feel already is the reason for the exception is not a pure tax motivation. The government may have other things as to why they're doing a particular exception to a rule. This is why I always like to understand the reason for the exception as opposed to trying to memorize a bunch of exceptions. If I can understand the reason for the rule, then when I encounter the problem a year from now, it'll jar in my mind at least, oh yeah, I bet there's an exception for that. And some of the exceptions here are to prop up the U.S. banking institutions, okay, to make their business better, to not have to compete as heavily against foreign investment or foreign banking institutions. So some of the things are not a pure tax policy perspective. They're trying to incentivize or make it more efficient for certain sectors of the economy. So you'll see some of that here, and I'll point those out. Okay. If connected with U.S. business income. So remember, U.S. business income of a foreign person is not subject to U.S. withholding. Right? When we talked about Chapter 10 a couple weeks ago, there's no withholding. You just file a tax return and you pay tax at the U.S. corporate rate. Okay? And you do that on the net basis of your taxation. So you got all of your income and you get to deduct expenses that directly relate to driving that taxable income, driving that gross income you get. Okay? So Adv income is connected with U.S. business income if such income streams, I think interest and royalties are very common, are derived from assets used in the U.S. business of the foreign person. Okay, so if the foreign person is not simply just a passive investor, but they also have a U.S. business, if those assets that are used in the U.S. business are deriving Adv income from U.S. sources, we don't withhold on that, even though it might be going to a foreign person, it just gets included on the tax return for the U.S. business income because it relates to that. Okay, so it could be a situation where the foreign person says, wait, do not withhold on that income stream because I intend to report that on my U.S. business income, in my U.S. business income on my U.S. corporate filing. Meaning that the income will be included there and be taxed on a net basis. You do not need to withhold. Okay? And to obtain that withholding exception for U.S. business income, this is part of the documentation element that we'll talk about. Meaning the foreign person intends to report it on the otherwise Adv income as part of its U.S. business income. They must submit Form W-8 ECI. And ECI is effectively connected income. If you remember what we talked about in Chapter 10, that's the U.S. business income. That's the technical term. It's effectively connected income with the United States. That's the U.S. business income. And that is titled a Certificate of Foreign Person's Claim that income is effectively connected with the conduct of a trade or business in the U.S. And you file that with the U.S. payroll. We're going to go through several of, we'll mention several of these forms. They all go by W-8 and they have a thing at the end of it. This one's ECI for this. But when you look at those forms, down at the very bottom, they have under penalties of perjury. And somebody has to sign that form. But absent actual knowledge that that is an incorrect form, the payor then has the documentation to say, I can withhold it 0 on this payment. Because somebody has certified to me that this payment is going to be included on the U.S. business income tax. Okay? And you can't file that form. If you file that form and sign it, and it is incorrect, then you are subject to penalty and criminal penalties as well, because you have filed a fraudulent form with the United States government. Okay? So that's the way the government enforces this. They put the stick over the person signing it. Are you signing a correct form, and is this actually going to happen? That is the evidence that the payor can then say, okay, I have sufficient evidence now. I don't have actual knowledge that that's not happening. Then I can rely on that statement and then file and pay the gross amount without withholding tax. And it'll be subsequently put on the tax. Okay, 9.3. Did anybody sign up for 9.3? Or they want 9.3? We want to see it started on first. Okay, I'll do it. I'll go. Oh, come on now. What is in the lead on class participation?
Exceptions to U.S. withholding on FBAP income. FOCO, a foreign corporation, maintains a textbook distribution branch in the United States. Due to the nature of the business, the US branch must typically hold large balances of cash from September 15 through December 15. Temporarily, the large cash balances are not necessary, and Foreco's US branch invests the cash in 90-day notes.
Okay, so let me pause you there. So we got a foreign corporation who is doing business in the United States via a US branch. Remember, those activities have to rise to the level of a business, which means I have income and I incur expenses in driving that income, right? This is a textbook distribution branch. That's going to meet that level of activity. What that means is Foreco is going to file a tax return in the United States reporting the results of that branch activity, that textbook distribution business, on 1120F. F means foreign, but it's a form 1120. It's a corporate tax return. You report income, report expenses, and pay tax of 21%. Right? So the question is, this income stream on the interest that is with the U.S. bank normally be paid to the branch. That branch is not a legal entity, right? It's just an extension of the foreign parent. So we would think, oh, I should withhold because this is a payment from the United States to a foreign party. Right? Take us through that last point.
So because the notes have a direct relationship to the trade or business, because the notes have a direct relationship to the trade or business of Foreco's US branch, Foreco derives an interest on 90-day notes from an asset using the trade or business.
Which is the cash, right? Because they deposited the cash with the U.S. bank getting the interest flow.
So as a result, this interest is ECI, that is effectively connected income, and the borrowers do not have to withhold.
And so it's weird here thinking of the borrower, but right, when you put money on deposit with the bank is the borrower. Right? Because you borrow your money and they're compensating you with interest by using your money for a certain period of time. So what this example would say is here, this WA-ECI, we need to get filed by Foreco with the bank and say, hey, this relates to my U.S. textbook distribution business. I intend to include this interest income on that tax return, sign in under penalty of perjury. Now, U.S. bank can pay the full amount of interest without withholding. That's the takeaway from this example. Okay? Perfect. Thank you. Now, that's totally different than if there was no U.S. branch. Right? If Foreco itself had excess cash and made a deposit, depending on what we're talking about in a moment, on another exception, the general rule would be there would be withholding on the income stream because it can't get included in trade or business if there is no trade or business. Okay, gain from the sale of U.S. personal property. Think all the way back to Chapter 3. Gain on the sale of U.S. personal property. What do we do with sales of personal property? The sourcing rule of that gain is generally seller's residence. Right? Not the location of the personal property. So, income derived from the sale of U.S. personal property by a foreign person is generally not subject to U.S. withholding as the income is not U.S. source. The proper source of which is determined by the seller's residence. This applies to all types of gains. So personal property is, right, this is not personal use property. It's not my laptop or my iPad or my car, right? It's personal property, which just means it's not real property. It's a broad category. If it's not real estate or something permanently affixed to real estate, then it is personal property. Desks, furniture, equipment, that type of thing. All of that is personal property, including stocks. Stocks are personal property. They're not real property. Right? So this applies to all types of gains, both capital and ordinary, including gains realized on the sale of stock of a U.S. corporation. Okay. So 9.1, I think we did have some. Yeah. So this is a really common scenario.
So for the simple way of pay a number 7 million, that's connected U.S. because he owns shares of U.S. corporation. And then if you would share the sells the shares of U.S. sub at a gain, the source of such income would be foreign source, as we do remember from the personal property sourcing rule. The sourcing of disposal of personal property is sourced based on the resident of the seller, so this will be foreign source. Because of that, this will U.S. withholding tax will not apply to this scenario since the stock is foreign source income.
So it doesn't matter that it's U.S. stock. It doesn't matter where the sales. Remember all the noise around the sourcing rules, where it was negotiated, where it was executed, where the documents are. Just brush all that aside. What is the rule? The rule here is seller's residence. This seller is a non-U.S. person. That means it is non-U.S. source. You don't have withholding on non-U.S. source income for a foreign person. Right? You don't have tax jurisdiction over that. Now, what the country of NRA, or their resident, may or may not tax the gain. That's that country's determination. Some countries do not tax capital gains. Some tax them the same as ordinary income. So that's a separate determination. Somebody, the tax advisor in that country would have to determine that. So think about what this means. It doesn't matter how much this is. This could be $1 billion gain. It doesn't matter. The gain is not U.S. source. You don't tax non-U.S. source income. So don't be thrown off by big numbers. So, oh, how can the sale of stock of a U.S. company at a massive gain not be subject to U.S. tax? That's the rule. And what's interesting here, we'll talk about in a moment, we'll talk about on Wednesday, sales of U.S. real estate. Real estate is always different. Why? You're not making more real estate. Right? So always think when you hear real estate, there might be a different rule here. The reason they give you the facts here, that U.S. sub has $4 million of cash and $6 million of machinery, is because it doesn't own a lot of real estate. There was real estate owned by the U.S. sub stock, the corporations under the U.S. sub corporation, then I might have an exception where the U.S. would tax some of that. Real estate's different. We'll cover that. But assuming it's just a regular operating business that is not heavily made up of value of real estate, doesn't matter the gain. What does this do? This incentivizes foreign investment in the United States. We like our stock market to have lots of owners, be very liquid, very active. So we want foreign individuals and foreign corporations to invest in the U.S. stock market. Right? This does that without having a lot of tax drag. Okay, the portfolio interest exception. Portfolio interest. I've always thought this was a weird name, but that's the name that's in the code, and people refer to it as such. But the portfolio interest exception is an exception to withholding tax on FDAP income. It is portfolio interest itself is paid from the U.S. to foreign persons, and it is not subject to withholding tax. What it is it's U.S. source interest. So this is interest paid on bonds, notes, and other debt obligations is issued by U.S. corporations, partnership, or government entities to certain foreign persons. And the key here is certain foreign persons, not all, certain, and meaning that this exception has exceptions. And those exceptions, so the portfolio interest exception does not apply to the following types of foreign lenders. Foreign shareholders who own 10% of the U.S. borrowing corporation. That's the inbound scenario where we have the foreign parent who owns an investment in a U.S. subsidiary, a sizable one, greater than 10%. And if they lend to the U.S. subsidiary, that will not qualify as portfolio interest for purposes of this exception. Okay? Meaning, I could withhold on that. Foreign banks receiving interest from U.S. borrowers. Okay? That cuts out a huge segment. The reason this is in here, when I'm prefacing that not all of this stuff is pure from a tax policy perspective, they didn't want foreign banks competing with U.S. banks. So U.S. banks were complaining, and U.S. financial institutions are prolific lobbyers of our politicians. And so they were like, we can't have foreign banks coming in here lending too much into the market because that's going to squeeze us out of the market. So do not allow them to get get interest income out of the United States without withholding tax, right? If they get hit with withholding tax, that is going to affect the economics of their lending. So that's they didn't want that to happen. Yes.
If like a foreign person owned part of like a unit of like an MLP, would they have to pay tax on that, like withholding tax, or no? Because it's domestic. Like if it's a domestic MLP, like if you own like an MLP in the United States, but you were foreign, how would that work?
Yeah. So you'd be a partner in the master limited partnership, right? And so you'd probably have to file an affirmative tax return in the United States by virtue of being a partner in the partnership.
So you'd still have to like file like a K-1.
Yeah.
Okay.
Exactly. You'd get a K-1, and then you would file and report that K-1 because you'd have a U.S. business.
Right.
At the end of the day. Now, what that might mean, that prior example or two ago, where the FDAP income stream related to that business, you might not have to get withholding tax, but you have to include that income stream in your file.
Okay.
Yeah, good question. Yeah, so you got to drill down into all these facts, and that's where the real world gets messy. Because you got all these flow-throughs and all these investment vehicles, and finding out who is the actual owner of the income stream is easier said than done. You got to really do some digging. Okay, so foreign banks are pulled out of the portfolio interest exception, which really narrows it down. And CFCs receiving interest from a related U.S. person. So remember CFCs? That's in our outbound context when I have a controlled foreign corporation, so it's owned by U.S. shareholders that collectively own greater than 50%. So if that is the lender to a related U.S. person, so then I have an outbound payment for the time value of that money, so that interest payment is coming from the U.S. to the CFC, that will not be available for the portfolio interest exception. So it's very narrow. The way I think of the portfolio interest exception is it's really for bond issuances to individuals and institutions abroad, not banks. Okay, so think of U.S. corporate bond issuers, right? They want the broadest market possible of owners of their bonds because that's going to give them the best pricing power and they can raise the most capital. So they want to have access to foreign owners of their bonds. One way the U.S. can incentivize that is to not affect the economics of that relationship by withholding on the interest payment to the foreign recipient of the bond. Okay, so that's what they're trying to do is open it up here, but then they wanted to curtail that for foreign banks. They didn't want foreign banks owning these instruments because that's competing against the U.S. banks. Okay, 9.7. What 9.7? So Norma Ray Allen, non-resident individual, alien, owns 8%, so that's a key point compared to those prior exceptions. Shares of USACO. USACO issues bearer bonds, so bonds that are paid to the holder of the instrument, only to foreign persons for $1,000 each that annually pay $70 of interest. Norma Ray Allen buys one of the bonds. As long as U.S. persons cannot own the bonds, these are requirements to get in the portfolio interest exception. If you are involved in bond issuances, you will no doubt know the portfolio interest, and there's certain requirements you have to do to make sure it cannot be held by a U.S. person. And the $70 of interest paid to foreign persons such as Norma Ray Allen is exempt from withholding under the portfolio interest exception, meaning that the full $70 goes to Norma Ray Allen, not 70 less some U.S. withholding. Okay? And Norma Ray Allen is not any one of these exceptions. She's not a foreign shareholder owning 10%, not a foreign bank, not a CFC receiving interest from that. Therefore, the portfolio interest exception applies. Down here at the bottom, it says, what if her ownership goes up to 10? That means she's going to hit this, this exception here. Be pulled out of the exception, so the exception applies. And that means the withholding tax goes to 30%, absent a tax treaty being in place. So instead of getting $70, she gets 70 less 21. So again, think of that in terms of bond issuance. What the focus of that is. Okay, U.S. bank deposit interest exception. U.S. source interest paid by U.S. banks on deposits made by foreign persons is not subject to U.S. withholding tax. Okay, this again is not theoretically sound. This is purely trying to make U.S. financial institutions look attractive because they can accept deposits and make payments on those deposits to foreign parties without subjecting the interest to withholding tax. So 9.8. Matt.
So Forco is a corporation organized in a South American country with an unstable banking system and currency, and as a result, Forco deposits all of its cash reserves with the First National Bank of Florida, which is a U.S. bank, obviously. And although the U.S. bank pays Forco a significant amount of U.S. source interest, there is no U.S. withholding tax due under the bank deposit.
And that is to encourage U.S. bank deposits by foreign parties. Okay, so you can imagine the U.S. banking institutions and their lobbying arms trying to argue for something like this because they want to be able to make withholding free payments to foreign parties and make them attractive for deposits. Okay, and this is very common because, like they say here, South America. Argentina is the one that's been the most famous over the decades with having a very volatile currency. And so these types of mechanisms will make it very easy for foreign parties to put money on deposit in the U.S. financial institution. Why is that important? Because that financial institution is now going to use that cash that's been deposited for their own lending and to make money on the spread. So U.S. bank deposits are interest. Okay, tax treaty reductions in withholding tax rates. We need a tax treaty in place, and we need to know that the foreign recipient is a resident in that tax treaty country. When we get into the materials towards the end of the half semester on tax treaties, we got to guard against someone inappropriately trying to avail of a treaty. So we have to make sure they're a resident of the country in which the U.S. has a tax treaty. And if they do, then that 30% is likely going to be something less. It differs across tax treaties. You might read something where it goes down to 10. The next treaty you pick up, it only goes down to 15. Some other treaty it might go to 0. That's where you just have to read each treaty and make sure that you know the income stream and then what's the withholding tax rate. In the case of dividends, the rate of withholding is often lower for controlling shareholders. And that is usually something greater than 10%. Again, you have to look at the exact terms in the treaty. But if the recipient is getting a dividend and they own greater than 10% of the dividend-paying corporation, many times you have a even lower withholding tax rate than if you own less than 10%. So if you're a very minor shareholder, you might get hit with 20%. If you're a controlling shareholder, it might drop down to 5%. Something like that. You have to look at the terms of each treaty. And it is not uncommon for tax treaties to lower withholding on interest and royalties down to 0. The reason being that they drop it down to 0 is because most countries treat interest income and royalty income as just subject to tax. So why am I withholding if you're going to tax the income side of that transaction? So many times both sides will decide we're going to drop those withholding tax rates to 0 because each one of us, when we get interest and royalties come from the other country, are going to tax those at our normal rates of tax. But again, you have to examine each treaty. Okay, personal service income. I think this is our last one for exceptions. 9.9. Go ahead.
So for example, 9.9, Forco is a corporation incorporated in country F, which has a treaty with the United States identical to the model treaty. Forco has a sales employee who does not have final contracting authority that spends 10 days each year traveling throughout the United States. The sales employee spends no more than a day in any locale and receives a salary from Forco. The salary of the sales employee does not incur U.S. tax because the sales employee is present in the United States for 183 days or less. Forco, a foreign resident, pays a sales employee, and neither a U.S. resident nor a U.S. permanent establishment of Forco in the United States bears the compensation costs.
So remember when we were talking about the temporary visit from an employee of a foreign party to the United States? This also happens when US has an employee that they send abroad for a temporary period of time. When I say temporary, like for a business meeting or for a conference or for a week of meetings with customers, right? Not something that's like 6 months or longer from a temporary standard. So when you get into a treaty context, both countries want to incentivize this type of economic activity, right? We want you doing business in our country. We want us to do business in your country. So we understand that that involves lots of times people traveling for business. And so what this is saying is just that individual, this traveling sales employee, is going to get compensation. The U.S. is not going to try to tax that compensation if you fall below these de minimis thresholds, which is length of time and usually the amount paid for these things. But this is a treaty scenario, so you look into the treaty and make sure that you fall below those things. And what that means is the person can be paid without there being U.S. withholding tax being withheld and remitted to the U.S. government on that. And so usually the HR departments for companies that are doing this type of activity are aware of these rules, or they work with a service provider who does know these rules, and they usually don't go beyond these thresholds. Because it's not to say that you wouldn't, but you know going in, if you exceed these thresholds, you got some more administration. Usually try to go right up against it. Okay, you can't go any further than this or any longer. So those are our exceptions to U.S. withholding tax on FDAP income. If you do not meet any of those, you do have a responsibility to withhold. You have to determine the rate. Okay. The withholding tax procedure, we've talked a little bit about this. The burden is on the U.S. payor to collect the proper withholding tax. Requires the payor to determine the country of residence and sometimes the legal type of legal entity of the payee. So I'd have to know, who am I paying into, and if it's an institution or an account, who is the actual owner of that account? I need to have visibility to that. If they do not collect the right amount and remit the proper amount, they could be liable. Therefore, they're typically conservative, as I was mentioning earlier, absent sufficient documentation. Foreign recipients of FDAP income file what is called a W-8-BEN. BEN stands for beneficial ownership. That's where they are putting forth the information on a form. This is not something that you do via email or a letter that's written. It's via U.S. tax form. That is W-8-BEN. That's a certificate of foreign status of beneficial owner for U.S. tax withholding and reporting. Foreign recipients use the W-8-BEN, the terms of that, it's not a very long form, to document their foreign status. Like they may say, I'm UK, here's my corporate ID number for the UK government. Right? Claim beneficial ownership, meaning that I am the owner of this. I don't have somebody making a deposit with me and then I'm making the investment so that you pay me and I pay them. I'm the owner of the income. And then if I want to claim a reduced rate of withholding under a tax treaty, you could say, I am a resident in my hypothetical of the UK, and the UK-US tax treaty, the way I read it, says I get 5% withholding tax rate, so I'm going to claim that. I think I'm entitled to that. Then you can rely on that W-8-BEN in the absence of actual knowledge that anything on that form is incorrect. If you know that that recipient is not a UK resident, or you know that that's an incorrect filing or fraudulent filing, you can't hide behind the form. Okay? But absent that knowledge, you are allowed to rely on that form and determine the appropriate rate of withholding tax. And again, the person who signs the W-8-BEN, right above it, you're signing under penalties of perjury, filing with the U.S. government. Ramifications. That's a fraudulent filing. 927. I'll do that one. Marie Allen again is a citizen and resident of a European country that has a tax treaty with the United States, similar to the model treaty. NRA is a shareholder of USA Co., U.S. corporation that pays dividends. NRA provides USA Co. with a form W-8-BEN, indicating that she is an individual, she's a resident of a particular European country. Unless USA Co. has actual knowledge or reason to know that NRA is not resident of that European country, USA Co. can rely on that form W-8-BEN and withhold at that treaty rate. So That's the responsibility of the recipient to provide this documentation. If not, I'm very confident that USACO is gonna withhold at 30%. Give me the information, or I'm gonna withhold at 30%, you're gonna get 70%. If you don't like that answer, give me the information. Because, right, USACO is the withholding agent and they're liable if the US government says that's an incorrect form or you should have withheld at 30. That's the dynamic that you have there, the conservatism that they place on these companies because they don't want to be held liable for this. You have to, before the payment, make sure you get your documentation. I've seen many times where companies come, oh, you only paid me 70, why'd you pay me 70? Well, I don't have any information about you, so I withhold at 30. And they're like, no, I'm UK and I'm entitled to the treaty. But then it becomes a quagmire, having to unwind all that. Much easier to do it right at the front end and not have to go chase a refund. Okay, we're going to pick up with sales of real property on Wednesday. I will dip into chapter 11 on Wednesday as well. That's the planning aspect. Please read through some of those cases. They say case, but they're not. They're just same examples as we have here. We're just labeled cases. They're pretty simple. They build on each one of each other and start going from there. Okay. Thank you. See you on Wednesday.
Or you can do like text.
跟一个韩国老奶奶在沟通，是城市上面沟通，她的韩式口音，我听不懂她的韩式口音，因为她也听不懂我在讲什么。然后我们就之间就有代沟，然后就变成这样子。
哎，你应该ChatGPT直接给他看，你知道吗？你就说我想剪一个什么样的图啊？
就是说他知道我是来自中国，然后就非要跟我中文跟我讲的问题，跟他的韩式中文，韩式中文，我们之间就有代沟。
我觉得还行啊。
那是因为长得一点。
Class of this right now.
That's 2:30.
Yeah, I have class right after. Your same room, yeah.
Oh, really?
Oh, nice.
You're texting him?
Yeah.
Yeah.
Oh, nice.
Yeah. Absolutely. And that's nice. So if you need right up there, so.
Have fun.
Yeah, I know.
结果我们起飞的时候，我感觉差不多一样。然后 delay 了，结果跟我们芝加哥的时候，他飞过芝加哥的时候就说，哦，不好意思，我们没有办法在芝加哥降落，我们要备降生。
So you did not get the slide. So you send me.
直接变直飞，然后我下飞机的时候，大家在鼓掌，然后大家说 congratulations， you are so lucky。然后因为我在登机前跟机长但是因为我跟机长先说过的话，因为飞机上只有一个人，然后机长就在广播里说，哦，他说 only one passengers 就会再收一次下飞机。 然后大家所有人都然后我就开始站起来，因为我开完座比较靠前，我就站起来。然后 congratulations， 然后所有人就开始在那鼓掌，然后 you're so lucky， 然后对了，
I like to let everybody in.
38分了。
Going? Not bad.
Just wanted to let you know.
嗯。
I'm sorry. We have 52 weeks for Christmas. I'm trying to get back. Yeah.
说他们就会。
No. Well, maybe do it so I don't forget. But yeah. What part you taking?
关键是最难的是，那飞机在天上盘着，没油了之后，附近3个机长都降不了，那怎么办法？
For some reason, I thought that I messed up the calendar, so I thought that the.
在飞机在跑道上卡着，你们下一下。
Yeah. This one.
对啊。 对啊，然后你们没有办法走，只能在飞机上看。哎，你跟航司发邮件，你可以申请